In this video, we're going to talk about working capital. Working capital, also known as net working capital, is the difference between a company's current assets and its current liabilities. And here's the formula. Examples of current liabilities would be cash, accounts receivables, inventories of raw materials, and finished goods. Examples of current assets would be accounts payable and short-term debts needed to be paid within a year. Working capital is a measure of a company's liquidity, operation efficiency, and short-term financial health. If a company has substantial positive working capital, then it should have the potential to invest and grow. If a company's working capital is negative, then it may have trouble growing or paying back creditors or even go bankrupt. Working capital days ratios are measures of efficiency. They provide an insight into how long cash is tied up for in a business. The calculations are based on three key components of the day-to-day operations of a business: inventories, receivables, and payables. These items are analyzed by calculating them as a percentage of sales and cost of goods sold, respectively. Many companies provide a credit period on sale, and receivable days shows how long on average customers are taking to pay. It is calculated as the ending receivables balance divided by sales for the reported period multiplied by the number of days the sales represent. Often the number of days is 365, which represents 1 full year of business operations. Inventory days provides the number of days of selling possible before the warehouse is emptied. This metric gives a good indication of whether a company is needlessly holding onto its inventory. Holding inventory in warehouses incurs costs to the business and might also indicate if the business is holding potential cash as unsold stock, which could be better used in other operations. The formula for inventory days is ending inventory divided by cost of goods sold and multiplied by number of days of cost of goods sold. Payables show the average number of days the business is taking to discharge its obligations to suppliers. A high positive number indicates the company has a free source of funding and can use that cash it owes to cover other costs. However, a low or even negative number suggests the business is not meeting the payment deadlines for its obligations. The formula for payable days is ending payables divided by COGS and multiplied by number of days of COGS. Working capital days ratio measures how efficiently a company is able to convert its working capital into revenue. The higher the number of days, the longer it takes for that company to convert to revenue. It shows how long cash is tied up in the company's working capital. Working capital days ratio is receivable days plus inventory days minus payable days. We will have an actual calculations with these formulas when building a three-statement model in financial modeling part of the videos.